24 seconds away from the opening bound this morning. Good morning to you all. Heading towards a week of gains on the S&P, pulling back just a touch on futures, down about 0.4%. On the Nasdaq, a similar move. The big story in Detroit, a strike on all three: GM, Stellantis, Ford. Those three names doing okay in the pre-market. We'll talk about how they perform coming out the other side. Here's your opening bound. Switch at the board and get to the bond market. Yields look like this on a 10-year, higher by a couple of basis points at 430.65. In foreign exchange, the dollar stronger, potentially for a ninth consecutive week against the euro, a record weekly run. This morning, the euro just a touch stronger by 0.2% at 106.65. And crude had a little look at 90, then pulled back. WTI, 89.35 and negative 0.9%. About 25 seconds into the session, we're down a third of 1% on the S&P. On the Nasdaq, we're down a third of 1% also. One sector to watch at the open: the automakers, GM and Ford, under pressure as the United Auto Workers start striking at select locations. UAW President Shawn Fain saying this strategy will keep the companies guessing, and if we need to go all out, we will. Abby has more. Hey, Abby.
Hey, John, it does seem that confusion and uncertainty are one of the biggest goals of the UAW in terms of this strike strategy. Some experts saying that it is probably one of the least painful ways that they could stage a strike against the big three automakers, although, of course, it is unprecedented in the fact that they are striking against all three at the same time. Now, on Friday, today, at midnight, workers walked out of the three plants, one from each of the big three companies in Missouri, Michigan, and Ohio. It's being called a stand-up strike, and this is the strategy of the UAW, that they can call up other members of the UAW to stand up at every time and create logistical, surgical, tactical problems for these automakers. Right now, it's less than 10% of the UAW's 145,000 members that have walked out, and again, to create the uncertainty for the big three. But for the stocks, John, there's not so much uncertainty. I would argue GM down 0.6% and Ford down 1.4%. It could be much worse if investors were really nervous. Now, that said, each of these stocks, including Stellantis, down between 10 to 20% from the July peak. So some of this is priced in. We've been talking about this for a while. And although the gap between the UAW and the automakers for a pay raise is wide, 20% to 36%, some are saying the fact that the UAW hasn't gone for the jugular, it may mean that there could be some sort of a deal in the works.
Abby, thank you. Let's see if we can close that deal sooner rather than later. Tesla might be loving what we're hearing. Dan Ives of Wedbush expecting one automaker in particular to benefit from the work stoppage, writing this: the clear winner in this Game of Thrones battle between the UAW versus the big three is Musk and Tesla, with Champagne now on ice, which sits in a non-union position, and its biggest potential EV competitors now face mounting costs and complexities in the years ahead, depending on how this ultimately plays out. Tesla this morning positive through much of the day. Turning to the media space, Disney is said to have had initial talks to sell its ABC network and other stations, the company writing in a statement: while we're open to considering a variety of strategic options, at this time we have made no decision with respect to ABC or any other property. Simone Foxman has this one. Hey, Simone.
Yeah, it's not just Nexstar, also potentially Byron Allen, who Bloomberg has reported, and we've been all over this story, has offered $10 billion for ABC TV network, local stations, as well as FX and National Geographic. While the company might not have made any decisions, though, analysts are already trying to pick through exactly what this would mean, both for Disney and its potential acquirers. And the commentary pretty mixed. Bloomberg Intelligence estimating that selling ABC and the local networks could potentially bring Disney $4 billion. Rosenblatt Securities believes this could be great for breakup value argument for Disney's equity, but it would be risky for Nexstar, whose shares rallied yesterday. KeyBank, however, saying that selling ABC would be negative for Disney because it would likely be done on a highly dilutive basis. And the interest in selling implies that Disney soon thinks pay TV will implode. The assets on the block, the idea, not completely surprising. This is something that CEO Bob Iger had hinted about back in July. But with Disney looking closing at its lowest since 2014 on September 7th, we're seeing some positivity in the shares today as everyone reacts to this news, John.
Simone, thank you. Let's turn to the semis just briefly. ARM seeing a successful day, first day of trading. trading, jumping nearly 25% in that debut. Needham initiating coverage on shares with a neutral rating and writing this. ARM can grow by capturing greater value from smartphones, but not enough to support upside from the stock's IPO valuation. Shonali Basak following this one. Hey, Shonali.
John, you might have heard about it. It's the AI frenzy, and you have ARM feeling the heat of it. Remember, when you look at Thursday, retail orders into Fidelity surpassed 20,000 orders for ARM. So you do have retail investors and institutions alike pouring into the stock. And today, when you look at it, have a second day of trading higher, you could say something today that you couldn't say yesterday, which is that ARM is finally valued above where SoftBank repurchased its stake for just a couple of weeks ago. That was at $64 billion. Now it's closer to $70 billion. But now its valuation alone is on the list of the risks that ARM faces ahead. That includes its nearly fourth of its sales tied to China and the risks tied to geopolitical risks in the chip wars, as well as declining smartphone sales, as well as profit alone, even at ARM facing pressures in the most recent fiscal year. Those are the list of risks that these investors face ahead. But today, yesterday, and into next week, as we face a whole horde of IPOs ahead of us, this so far is not an issue.
Shonali, thank you. The stock up again by 3.8%. Turning to Adobe, the software company delivered a mild sales forecast despite the optimism in AI. The CEO saying this: "We are unleashing a new era of AI-enhanced creativity around the world with innovations across our product portfolio." Isabel Lee on top of this one. Hey, Isabel.
Hey, John. So just like a lot of other companies, Adobe has been getting a lot of mileage out of AI, but over-optimistic investors are just wanting for more, which is why even if sales forecasts meet expectations, we see shares slumping to around 5%. So here are some numbers. Sales will be $4.98 to $5.03 billion in the period ending November. Analysts were expecting around $5 billion on average. Profit excluding some items will be as much as $4.15. So that's 9 cents higher than estimates. So Adobe is adding generative AI to a lot of its products, and they will be increasing those products beginning November. And analysts expect this new increase to lift revenue quickly. We have William Blair expecting that it will add around $600 million over the next year, and Bloomberg Intelligence projects a 10% sales increase in the first year. But of course, there's a flip side for everything. Some express caution that the price increase would affect demand, John. But for now, Adobe has rallied some 60% year to date.
It's just down this morning by 4%. Isabel, thank you. Joining us now to discuss this market, Mandy Zhu of SEP Global Markets alongside Mohammed Al-Arian. Mandy, let's get straight to it. The VIX, you know the complaints. Has it become totally irrelevant?
We don't think so. I mean, I think the decline in the VIX obviously has puzzled a lot of investors this year, but I would say it's really a reflection of the change in the macro environment, right? So when we started this year, the consensus among economists, among investors was very much, recession risk in the U.S. And now as we stand here, 9 months later, the consensus has turned into a soft landing. And that's why the decline in volatility has really been across asset classes. We're seeing it in FX, we're seeing it in rates, we're seeing it in commodities, in credit. It's really in line and in sync with the other asset classes, which suggests to me that it's very much macro-driven rather than anything equity-specific.
That's your observation. Let's get your judgment. Do you think those soft landing hopes and dreams are relevant? Do you share them?
Look, I mean, there's clearly still a lot of risks, going forward. And I think that's why we are starting to see a pickup in option volumes in VIX, particularly investors coming in to buy those VIX upside calls and call spreads. VIX option volumes are actually on pace to hit a record this year, which I think surprises a lot of people given, the market rally. And I've gotten a lot of questions around kind of why the interest in hedging now versus last year when the market was actually selling off. And I do think a big part of it is positioning, right? People have capitulated to the soft landing view. We're seeing leverage really start to build. Institutional investors really start to increase their allocation to equities, systematic strategies, increasing their allocation as well. So as leverage builds, that's when you could potentially get, that convex move in volatility. And I think that is driving a lot of that interest in those VIX upside calls.
So Mandy, we're looking at two worlds. One where things are relatively calm, you just described it, and it's reflected in the VIX. Another one, whether it's in rates or in FX, where people are seeing major relative price changes. John mentioned dollar stronger 9 weeks in a row. We've seen what has happened to U.S. rates relative to the rest of the world. Can we live in this two-world world, or at some point do we see convergence? And what does that convergence look like?
That's a great question. Can we live in this world? We've been living in this world for about 2 years now, where we've had elevated rates of volatility and relatively more subdued equity volatility. And what I would say is, that divergence is only a mispricing if you think the volatilities in each of these asset classes reflect the same risk. And I would argue they actually do not, right? Rates volatility is really a function of policy outlook uncertainty. And as we stand today, there's still a lot of uncertainty of whether ultimately terminal rates going to end up, right? Could we see rates, Fed taking rates above 5%, 6%? Yes, absolutely. Could they, be cutting rates if economic situation turns? Absolutely. But I think for equities and for a lot of risky assets, what really drives volatility in those asset classes is the risk of recession. And that has undeniably gone down over the past year as we have seen, labor market data hold up and inflation come down. So I think that's what is driving it. And then specifically with the VIX, I would just say, given that it's a 30-day measure of implied volatility in the S&P, it's much more catalyst-driven rather than a gauge for long-term recession risk.
I'm pleased you mentioned that number 30. I want to talk about this one, 0. Mandy, just briefly, 0-day to expiry options. We've had a long conversation about that over the last 12, 18 months. Mandy, there's a lot of volume there, an explosion in volume coming out of the pandemic. From your perspective, does high volume equal high risk?
No, it does not. And I think that's the source of the misunderstanding in this product, right? So yes, 50% of option volumes in S&P is going through these 0-day to expiry options. So people often quote the notional number, 500 billion a day trade in these 0 DTE products. But what matters at the end of the day is the net balance between buys versus sells. If everyone is chasing, one side of the trade, then potentially, yes, that could pose risk. But if the flow is evenly split between buys versus sells, then at the end of the day, the net risk to market makers hedging those positions is very minimal. And what we see, and again, at SIBO, we see all this flow, right? All these options trade on our exchange. And what we see is that the flow is remarkably close to 50-50. And that at the end of the day, the net risk to market makers having to hedge those options, we're talking about, 0.1% of the S&P daily liquidity. So this is not a case of the tail wagging the dog at all.
Mandy, appreciate the update. Mandy Zhu there of SIBO. Mohammed, let's talk about this market more broadly. You remember the days when we had 0 rates, we had QE forever, and people would come on programs like this one and say we can't possibly go back to 5%. This is what the market is built on now. I take Europe as an example. I never thought we'd go to 4% over the ECB. I thought it was a potential in the pandemic that we'd never see a rate hike from this ECB for the next cycle, never mind the last one. And here we are. Do you think we can adjust and have adjusted to these high rates?
So far we've adjusted remarkably well. Remember, it's a trilemma. How do you reduce inflation without pushing the economy into recession and without causing excessive financial volatility? And so far, in the US, we have achieved all three. So far, so good. However, remember, especially if rates stay higher for longer, there are things that have to be refinanced in this economy that cannot be refinanced in an orderly fashion at these rates. So this is not something that happens instantaneously. It's something that happens over time. Now in the UK, because the mortgage market has such short duration, it happens very quickly. Here it happens more slowly. And that's why the long bit of higher for longer is really important. How long is longer?
So the effective rate on mortgages right now in this country is 3.6%. Torsten Slok of Apollo put out some work over the weekend, and I'm sure you're familiar with it. Ultimately, at origination, I think about 10% of the mortgage market is paying above 6%, so we're just not there yet. And to your point, because it's 30 years, it could take a long time. I'm thinking more specifically about high yield. Is there a spot on the calendar where corporations below a certain grade are going to come to market and they're going to have some problems?
Yes. I mean, if you look at high yield, if you look at commercial real estate, massive refinancing needs next year. Massive. So that's the point of pain that starts to happen. Now, some people will tell you there's lots of distressed credit funds with lots of money waiting to come in. And we're going to see a game of chicken between the two. That's what we're going to see.
Is that a story for next year or the year after?
I think it's a story for next year. And we've got to be really careful. That's why the minute the market starts pushing back rate cuts, and it hasn't really pushed it back, but the minute it starts pushing back rate cuts, the conversation gets a lot more interested in various segments.
And more data like the data we've had this week, and maybe we go in that direction. Mohammed, stick with us. Coming up, looking ahead to a Fed rate decision.
I think they'll be inclined to deliver a hawkish pause. If you look at the underlying trends, core inflation is moving in the direction they want. So I think what we'll see next week is a pause, but an indication that they're prepared to do more.
Chair Powell taking center stage in a busy week for monetary policy. That conversation up next.
I think they'll be inclined to deliver a hawkish pause. They have gotten good news on inflation. Yesterday, a mixed report, but if you look at the underlying trends, core inflation is moving in the direction they want. So I think what we'll see next week is a pause, but an indication that they're prepared to do more. And I would expect them, I think it's finally balanced, but I would expect them probably to get one more hike in this cycle.
Former Fed Vice Chair Richard Clarida on the Fed's next move. The September FOMC meeting kicking off next Tuesday, leading a busy week ahead for policymakers with rate decisions coming from the Bank of England and the Bank of Japan. Mike McKee has more. Morning, Mike.
Morning, John. We're all traveling next week. I get to go to Washington. You get to go check on the Bank of England. Maybe we should meet in Tokyo when we're all done, because it is a big week with three central banks who have the same problem, inflation, and the Japanese have actually joined that party. Take a look at the inflation rates in all of these countries. You can see the Bank of England's problem. They have a very large inflation problem. The U.S. has made a lot of progress, but we just ticked up a bit. So does the Fed raise rates? The betting is is. They probably will. And the Japanese are now above zero and have been there long enough, and the odds are they're going to keep inflation high according to the latest forecast. So they may start tightening policy a little bit as well, which leads us to what's going to happen in the markets. Well, the bet is nothing from the Fed, even though Rich Clarida was suggesting a hawkish pause. Nobody thinks they're actually going to hawk out and raise rates. About a 3.8% chance, as you can see. There is a bet, a strong bet on the Bank of England moving, and now there's a bet on the Bank of Japan. We haven't had that in a very long time. What do all three of these have in common? The U.S. dollar. The dollar has been strengthening because the Fed keeps raising interest rates, and because the U.S. is the biggest economy in the world, it's affecting everybody else. You can see the impact on the pound, and you can see the impact on the yen. I reversed the yen so you could get an impression of what it's actually doing. It's getting weaker, and that's a question for the Fed. Do they care? They care. They don't want to hurt other people, but their job is the United States. So expect the dollar to stay strong for now, and it's going to have an impact on the rest of the world. I guess you have somebody sitting with you who has a pretty good handle on cross-currency issues for people who work in two parts of the world.
That's a question for Mohammed Maliki. Mohammed, have we got a dollar problem for all these central banks?
So in the past, whenever we've seen a very sharp appreciation in the dollar, it has tended to break something. What I thought was really interesting from Mike's comments is the Bank of Japan. I don't think the potential for the Fed to surprise is very large. It will keep rates unchanged, nor do I think the potential for the Bank of England to surprise is very large. It will raise 25 basis points. The big uncertainty is the Bank of Japan. And that is what I think markets haven't understood. It's not as much rates as the yield curve control. Do we get another signal that they are easing out of yield curve control territory?
Well, where do you think they are now? What is the actual policy on yield curve control of the BOJ?
So they're tolerating a 70 basis point 10-year, which was unthinkable 6 months ago. And I think they may indicate that they're willing to tolerate something more, and the rate will move immediately on that news.
Governor Wade has suggested that maybe they do raise interest rates at the end of this year and abandon negative interest rate policy. Do you think we should be paying attention to that as well?
We should absolutely be paying attention, not because of the rate spillover, but because the Japanese are very big owners of foreign securities.
Okay, so the next question is, what does that mean for treasuries? So the anchors have gone now. Put the market away. ECB is done with all of this. Bank of Japan said to follow potentially, given what you've just said. Does that mean a new floor for treasuries or a new ceiling for treasury yields?
So first, the policy anchors have gone away. Okay, the economic anchor is still holding in the U.S. That's really important. It's important for the U.S. It's important for the rest of the world. And then there are the technicals. The good news for most market participants is that the technicals are favorable. Keep a very close eye on the 10-year if it gets to 0.35, 4.35. That is a major resistance point. And if it goes through there, then people are going to start talking about 450, 475, and it's going to be a different narrative.
Interesting. 433 right now, by the way, on a 10-year Treasury. Mohammed, stick with us. Coming up on the program, I'll run you through the trading diary, the calendar for the week ahead. From New York, this is Bloomberg. Let's get to the calendar. The week ahead looks like this. At the top of the hour, UMich Consumer Sentiment Survey Plus. President Biden expected to address the UAW strike later today. Wednesday, Fed rate decision, Pound News Conference. Thursday, the Bank of England's turn. And finally on Friday, it's the BOJ. Mohammed with us around the table in New York. Mohammed, what a week.
What a week, and next week will be also what a week.
What stands out for you this week?
4 things: U.S. growth exceptionalism. 2, the return of some inflationary pressure. 3, Europe deep into stagflationary risk. And finally, Japan likely to exit YCC much quicker than most people expect. That is quite a combination for 1 week.
Stagflation, risk or reality in Europe?
I fear it's going to be a reality. I really worry about that, John.
That is brutal. It just looked terrible for them this week, didn't it? What's the answer? What's the policy response you should have when you confront that into next year?
So I know what the ECB is going to do. It's going to stick to its single mandate. I think policymakers have to do a lot more on the industrial policy side because they have to take advantage of this opening as a transition in the growth model, something that's absolutely critical.
Interesting. Mohammed, just fantastic to see you, as always. Thanks for being with us. Mohammed Al-Arian from New York City. That does it for me. Have a fantastic weekend. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
About that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is
30 minutes into the U.S. trading day, Friday, September 15th. Here are the top market stories that we are following for you at this hour. At not so good September feeling, stocks go nowhere this month. We get the latest consumer read with Joanne Shu, University of Michigan surveys of consumers director, and targeted auto strikes. The UAW begins an unprecedented strike at the big three automakers. We're going to speak with Mary Barra, CEO of GM. And Euro's record run of losses. Euro dollar is headed for its 9th straight week of losses, a record. We're going to speak to French Finance Minister Bruno Le Maire. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. All right, Guy, you missed. What do you get?
Two-year yield drops. Inflation expectations come down to 3.1. The 1 year, the 5 to 10 come down to 2.7. These are big drops. The headline number drops to 67.7. These are post-SWIFT numbers, Alex. I.e. the summer frenzy is over. Is that going to start to have an effect? The next question is, what does the government shutdown do to these kinds of numbers, and what does the UAW strike do to these kinds of numbers?
I like the fact that you said the post-Taylor Swift, because that's not nothing. And also what we've seen is oil now around $90 a barrel, and then gasoline prices also inching up as well. So we're going to get perspective in just a little bit as to how that's going to decrease consumer confidence within the U.S. And you mentioned the auto strike. Same thing. It's starting off. It is one of our big stories. The UAW workers striking today against the big three automakers. You have work stopped at various plants from Ford, GM, and Stellantis. Joining us now, David Weston, Wall Street Week anchor, and Mary Barra, the CEO of General Motors.
For our Bloomberg television and radio audiences worldwide, I'm David Weston. We're welcome now Mary Barra. She is the General Motors chair and CEO. So Mary, you are the woman of the hour, I must say, whether you like it or not. Let me ask the question I think on everyone's mind. What comes next? We know there's individual plants that have been struck at all three of the big automakers in Detroit. How far away are we from layoffs as other plants really run out of the parts?
Well, David, first I want to say I'm extremely disappointed and frustrated that we're even on a strike. We didn't need to get here. General Motors has an exceptionally strong offer on the table. It's historic. It's the largest increase from a wages perspective in our 115-year history, along with world-class health care benefits and many other provisions, job security, et cetera, and a COLA adjustment. So when you look at the strength of the agreement we have on the table, we really don't need to be here. Yes, they have one plant down right now, and it'll impact three very important products. Two brand new, our Chevrolet Colorado and our GMC Canyon, both mid-size pickups that are in strong demand, as well as our Chevrolet cargo van that does exceptionally well in the market. So this is having an impact, and we'll have to see where they go next. I will say we're ready for this. As we've dealt with COVID and dealt with the semiconductor shortage, as well as other supply chain challenges that have continued to persist from COVID. Our team knows how to manage these situations. They're staying agile, and we're going to do what's right for the company. We're going to make sure everyone stays safe. But this is a strike that didn't need to happen.
Mary, as you say, you've made an offer already for a rather substantial increase in wages. It's not what the UAW wants. Implicitly, you've agreed that they do need and deserve some increase in wages. But is this about more than that? Is this existential in a sense for the auto companies in terms of your need to move into electric vehicles, and from the UAW's point of view, that they believe that in fact moving to EVs will actually cut the workforce by as much as 40%?
Well, you're absolutely right. This is a once-in-a-century transformation we're in the middle of moving from internal combustion engine vehicles to electric vehicles. And at GM, we're at a very pivotal point because we have so many electric vehicles ready to launch, in the process of launching. And this is important to securing all of our futures. We need to get these vehicles out. They're wonderful vehicles. We've got waiting lists for most of them, or orders already in place. So it's important that we meet that demand. And one thing from a General Motors perspective, from job security, we have jobs for all of our people as we make this transformation. More than 2 years ago, we started planning for this. And one of the reasons General Motors invested in doing our own power units, which is a component that's very important on an electric vehicle, we designed them internally, and we are now allocating that production to the plants that build internal combustion vehicle engines right now. So we have worked very carefully to have a job for everyone so we can make this transformation together. And frankly, certainly when you put have a strike and we're not making vehicles, you start to put that at risk. So it's a historic transformation. We need to make sure we can compete, and we need the company to be profitable because those profits get invested in new products that, again, it's a circle of when we invest in a new product, there's demand for that product from consumers that provides the jobs because we're building those vehicles in our plants. We need to invest in our future, and we have a plan to take all of our employees along. I think this is very important. So that concern there's not a place for them is not true at General Motors.
If, Mary, you were to find it in your heart to come close to what they demand, to accept it, what would it mean for the future of General Motors? You've just come out of bankruptcy 15 years ago, as I recall.
You know, I think that's a very important point, because if we can't invest in new vehicles, which we need to be profitable to do that, then we're not going to have a strong future. And David, you know extremely well, this is a very competitive industry. There's new entrants that are not represented by the UAW that already had a lower wage structure. So we need to compete. I'm really proud of our manufacturing team, the way they managed through COVID, the way that they have worked and been very agile as we've dealt with all the supply chain shortages, and the fact that for the last 2 years, between our engineering and our manufacturing teams, they've delivered world-class quality as recognized by J.D. Powers. We have a strong team. We want to do everything in our power to win the future, secure their future, and lead for the next 115 years. We need to be able to do that.
Mary, are the negotiating teams meeting today, to the best of your knowledge? And by the way, are you participating directly in any way?
I have been participating. I've been involved since before July 18th when the talks kicked off. I've been on call more than once a day, calls, texts, meetings, and I have been at the main table myself over the last few days. I'll continue to be extremely involved. Our team's ready. They're there waiting to negotiate. So, my request is the UAW leadership needs to get back to the table so we can get these problems solved, get our people back to work. I think another important point is for every job that General Motors has, there's 6 more jobs in the economy that depend on us running. So this is broader than just General Motors. This is important for the plant cities especially, but really for the nation.
Yeah, we talk about 150,000, potentially it's a lot more than that, to your point there. Lastly, Mary, I'm mindful of the fact that your father was a tool and die maker at Pontiac, when my father was a tool and die maker at AC Sparkplug, just some 30 miles apart. You and I, as young people, have gone through UAW strikes, different from this one, but we've gone through them. What do you think our fathers, if they were with us today, what do you think they'd say to each other about what we're seeing right now?
Well, I think my father would say, as he looked at the historic deal that we put on the table, that the company is committed and wants to recognize our employees for their hard work and wants to make sure they have a secure future. So I think he would look at this offer, and if it was on the table for him to vote, he'd vote yes.
Okay, Mary, thank you so much for your time. As I say, on a very, very busy day for you. I really appreciate it. That's Mary Barra. She's General Motors Chair and CEO.
All right, thanks so much, David Weston, joining Mary Barra there, the GM, CEO and Chair. So all of this, as we kind of work towards some kind of agreement, did we learn anything? Tom Narayan is Global Autos Analyst at RBC Capital Markets. You were listening to the interview, Tom. What did you make of it? What is this signal for the setup of the conversation going forward?
Yeah, I think she really put it out really well. I mean, if you look at the difference in where the UAW was and where the auto industry was, they were out very, very wide dispersion between the two. The UAW wanted 40+% wage increase. The OEMs were coming out obviously like the 10% level. And since then, the OEMs have come back up to closer to 20%. I also noted something very interesting she said about electrification. They are finding ways so that labor can be used and reallocated from ICE engines to making EV components. And when I was the European autos analyst for 4 years, I noticed this was already happened a few years ago with Peugeot that became Stellantis. They did the same thing. So the OEMs are trying their best to find places for these workers to go. They have increased the wages in the latest proposal all the way up to close to 20%. And we have to also not forget they went through 3 years of underproduction. And what happened? They've kept elevated pricing, which has been really profitable for the OEMs. So I think people need to remember, lower volumes in a work stoppage. The OEMs have been through this for the past 3 years and come out on top. because they've had strong price mix, which has led to profitability. You know, if I were on the labor side, I'd be worried about that, frankly. Like, the OEMs can get through this because they have really strong pricing right now. All this would do is just keep pricing elevated for longer.
So, ironically, Tom, what you're suggesting is that the OEMs may be more profitable as a result of a strike. Am I hearing that right?
I mean, you know, the big bear thesis I hear from clients is, oh my God, pricing is going to fall, inventory levels are going to come back up, and that's going to be a disaster for the OEMs because they've had peak earnings. But what happens if you have a work stoppage and you're not producing cars, inventory levels stay low, and we can have high pricing for cars for longer? Remember, lower volumes has a less bad impact to automakers than lower pricing does. Pricing drops 100% to operating profit. So in a weird way, this isn't as bad as we're hearing all the optics, you know, in the media. No offense. I think basically it's something that folks need to pay attention to.
Tom, what is the inventory like for these three guys?
Inventory levels are still below, you know, the 2019 levels for sure, but they have been coming up. And a lot of people think, oh boy, this means pricing is going to come down in 2024. But all this work stoppage does, if it's 6 weeks, if it's 8 weeks, is just lengthen this period where price mix stays elevated. So it's definitely still well below 2019 levels.
Tom, Mary was addressing how many jobs in the supply chain are dependent on the OEMs. Is this an opportunity for the supply chain to catch up? Is this an opportunity for the supply chain to become more robust?
Yeah, I think so. And remember, they've been doing this, right? We've had 3 straight years where the supply chain has had to kind of readjust. And just remember, look at the amount of automation that's in some of these plants now versus, let's say, 10 years ago. It's a lot more. And we saw the numbers that Ford put out in terms of the labor cost, of the percentage of their total cost of goods sold, a lot lower now than it was before. So these companies have done a lot, the supply chain, the OEMs themselves, to right-size their you know, their cost structure. It's a lot less, you know, painful for them to deal with this than it has been in the past.
There was there's also the narrative that all of this is going to be a huge boost to the non-union automakers like Tesla or Toyota operate here in the U.S. Is that true? Is that a real argument?
That certainly could be something to be said by that. But, you know, at the end of the day, yeah, it would be the case if they could gain market share, certainly, right? Where the U.S. OEMs hit by the strike aren't selling vehicles. So there's some of that, certainly, sure. But I mean, that's more on the BEV side for Tesla. I don't know how competitive that is with some of these products that are being cut out right now. So I don't know if that's as big of an issue.
Tom, can the Europeans protect their car industry from Chinese EV imports? Can they really do that?
That's a totally different question. There's an obstacle, right, you're very well aware of, which is the Germans aren't really that excited about going against the Chinese, right? So, like, but certainly the French probably do. So it all comes down to whether or not, you know, the EU can kind of come to an agreement and put in some tariffs. I think it's a lot harder for them. That's why you don't have an IRA in Europe, right? So it's politically, they're very dependent on exports to China. I think that's going to be difficult to deal with. But you know, we'll see. I think things in Europe are very tough to get to the goal line.
Tom Narayan, thank you very much indeed. Perfect timing. Great stuff. Global also analyst at RBC Capital Markets. Another story we certainly firmly focus on today is the European finance ministers meeting. It is taking place in Spain. This comes, of course, a day after the ECB hiked rates. Maria Tadeo is there. She is joined now by the French finance minister, Bruno Le Maire, in a Bloomberg exclusive.
Yes, thank you so much, Guy. And time is of the essence, so let's get to it. We are joined, as you say, by the French finance minister, Bruno Le Maire. Thank you so much for joining us. Obviously, you knew I was going to ask you as a first question, what's your take on the European Central Bank? Because they hiked again, rates of 4%. Some say enough is enough. They have to stop. What's your take?
You know, the ECB is independent, but I would like to quote what Christine Lagarde said. I think that we are at the right level of interest rates in the EU to stop inflation and to reduce inflation, and this is the goal of these interest rates, to reduce inflation. We are on the right track, and I think, as Christine Lagarde said, that we should stick to that level of interest rates. It is the right level to reduce inflation.
So if I read between the lines, what you say is that you feel this was 25 basis points and it's over. Let's keep them high for long, but don't add.
Since we are on the verge of reducing inflation, we're on the right track. I don't see, as Christine Lagarde said, any need to go any further. 4%, that's a very high level of interest rates. It might have some impact on the level of growth, on the level of activity. So we are on the right track to reduce inflation, which is, and which must be our common goal. Enough is enough.
Okay, well, that was very clear, in fact. Let's move on to the other big topic, because we should talk about this week, and this was a massive decision, and we saw reflected in the market immediately, the auto sectors. There is now a probe that is going to start into Chinese electric vehicles. The head of the European Commission said they have flooded, quote, the market with cheap subsidies. This was a political victory for your country. You wanted this included by the Commission. Now you have it. What are you going to get out of it?
It is a decision of the Commission, but we support this decision. No, we did not push anything. We just want to have a fair competition between China and the EU. China is a key partner for the EU. But the partnership, the economic partnership between our two continents, between China and the EU, must be based on the same rules and must be based on a level playing field. So if there is any doubt that there is really a level playing field between China and the EU, it's up to the Commission to launch this anti-subsidies investigation. This investigation is most welcome. It is nothing against China, nothing against our Chinese partner, just for the sake of preserving the same rules.
And do you fear, however, that the Chinese are not going to look at that in the same way, that this is going to lead to a trade war? I mean, that's some of the fears reflected over the past 48 hours. Is this going to unleash potentially a trade war?
No, that's exactly what we want to avoid. We are not here to trigger any kind of trade war. We are just here to ensure that fair rules are being implemented by all partners, whether by China or by any other partner. The responsibility of the Commission is to ensure that trade is based on fair rules and reciprocity. That's the meaning of this anti-subsidies investigation.
Even if you have all of your very nice handbags that you sent, all of the luxury goods that go to China, Airbus, also big companies that you produce, whereas China says, well, if you're being protectionist or what we perceive as protectionist, then we're going to do the nice same thing to you. Is that something that you factor here at some point?
It has nothing to do with protectionism. Applying the rules, abiding by the rules of the WTO is not protectionism, it's fair trade. China is a member of the WTO. All EU member states are members of the WTO. We have to abide by the same rules. Nothing to do with protectionism. It is only the best way of ensuring that the rules are the same for everybody.
Can I ask you, some say, because there is always this fear of what China may do, that it has prevented action in areas where some would argue it is very fair to say China abuses its position. In Europe, it wiped out the entire solar industry. The Commission referred to this. Companies that were very good that went into bankruptcy. Should we say at one point in the European Union, there is no need to fear China? It's a trap to think we can't take action because we fear China.
I think it's good news that Europe realizes the necessity to defend its economic interests. The US are defending their economic interest. China is defending its economic interest. The EU must do the same. And this investigation is the best way of explaining, well, we have economic interests. We want trade to be based on fair rules, so we will ensure that the rules are the same for everybody. We don't have to fear any country. We are the EU. We are the single market. We are one of the most powerful economic continents in the world. We need to defend our economic, financial, social, environmental interests.
And is this the beginning of a bigger rethinking? Because we go into electric cars, but would you say it may not be just the EVs? Maybe there's a whole range of areas that we should take a look at, what the state of that fair play is.
On all areas, we have to ensure. On all areas, maybe solar panels, maybe other areas, we have to ensure that trade is based on fair rules. It is maybe the beginning of a new period, a new era, where the EU starts thinking about its own interest, starts looking at the rules that have been decided and have been applied, and starts thinking about defending its interests.
And let's talk about the French economy. Well, to be fair, what you're trying to do is overtake Germany, right? That's your goal. You want to be the biggest economy in the euro area.
Our goal is clearly to have growth in France and to have growth in Germany. Germany is our first economic partner. This is not good news when you have Germany facing recession, because of course it has a direct impact on the level of activity in France. So I really want to have more growth in Europe. And this is one of the key challenges for 2024. I explained to my colleagues today in Spain that we cannot be satisfied with the level of growth that we have today in Europe and that is forecast for 2024. We cannot be satisfied by the slowdown in Europe. There is growth in the US and a slowdown in the EU. We must take decisive steps to give a new impetus and to get a solid, sustainable and stronger growth in 2024.
And that slowdown, do you think it will affect your country? Because a lot of the credibility of the French government depends on showing that there is sustainable growth now.
We have growth in 2023, 1%. We will have more growth in 2024. Our forecast is 1.4. But I strongly believe that we should define altogether a new economic and industrial strategy for EU based on cheap electricity prices, based on the simplification of the norms. And we are really fully determined with Christian Lindner to give an impetus to that idea. Third, based on innovation and investment. And fourth, based on competitiveness.
And when you spoke to Christian Lindner, there's also this, and that's your German counterpart, there's also a big debate about the European fiscal rules. The Germans are clear, they want to see benchmarks for debt deficit. Others say this is just stifling the economy. I mean, you're fixated on numbers that have not produced massive investment across the European Union. Next year, if there isn't a fiscal rules reform, you're going to see countries that could get punished for not hitting those numbers. Some will say that is just, it is crazy. It makes no sense. Is that acceptable to you?
I want to make things very clear. France wants to have sound public finances everywhere in the Eurozone. We want rules. But we want rules that will not kill growth. Rules of the Stability and Growth Pact are necessary to ensure sound public finances, but it must also provide the fiscal space to have also growth, jobs, prosperity in Europe.
And the Germans get that?
I think that the balance between investment and sound public finances is the key challenge that we have to face when we are defining these new rules for the Stability and Growth Pact. The second point, which is absolutely key, as you said, is to do our best efforts to come to a compromise by the end of 2023, because we need to give the signal to our citizens, to all the member states and also to the markets, that we stand ready to have new efficient rules for the Stability and Growth Pact.
And funnily enough, this time it's Germany that may head into recession before anyone else. But I wonder, the market is becoming very negative on Europe, and it has done so now for weeks. Do you believe this idea of stagflation, is that a real risk, or there's too much negativity around the European story at this point?
I think there is too much negativity.
You don't believe in stagflation?
I believe that there is a necessity to give a new impetus to growth, to get a stronger and more sustainable growth. When we are talking about capital market union with Christian Lindner, I've been negotiating the capital market union for more than 6 years. And what is the result now? Nothing. So we need to move on. We need to decide. We need to have this capital market union to provide more funding to the innovation, to the disruptive technologies, to growth. That's the key point. I'm not an observer of the political life in Europe. I'm an actor. As an actor, I want more growth, more jobs, more prosperity, and there is a necessity to take some decisions to go this way.
And as an actor too, can I just ask you, did you get any phone calls from any French CEO this week when that probe was announced saying, how is this going to affect us? If China gets tough on us, we're going to have any problems. Did you have any sign from the French corporate sector, which we know is very strong, saying, are we sure we want to do this?
I got some phone calls, to be very frank. I got some phone calls, but my response was quite clear. What do you want? What do you want? A weak Europe or a strong Europe? I think that we need a strong Europe. And a strong Europe is a continent and a political project which is able to defend its interests.
Well, this is very important. So you said CEOs called you and they said, can we get an explanation? And you said, we want to do it for a stronger Europe.
We want to do it for a stronger Europe. We need to have a fair competition between China and the EU. And if you want a fair competition between China and the EU, you need a strong Europe.
And you're not going to tell me who was on the phone?
No.
Okay, well,
thank you so much.
So much for joining us on Bloomberg TV. Always a pleasure to see you. And Alex, of course, that was the French finance minister with us here at this Eurogroup in Spain. Thanks.
All right, Maria, thanks so much. Really appreciate it. Really interesting conversation and very timely as well as we have the auto strike here in the U.S. So, Guy, I mean, I think there are really big issues that I don't know how you resolve quickly and easily.
Yep.
What it does seem is that the U.S. and Europe are just behind on manufacturing for EVs, and they're going to have to find ways to ramp it up and kind of all options on the table, but it is happening.
It is happening, and it's going to be interesting to see the kind of different tracks and different paths that are taking. But what I hear loud and clear is that there is a certain degree of protectionism of home turf.
Yes.
And I think that's just going to be the reality of the situation. I think the French are playing with fire, though, with the Chinese. Airbus, hugely dependent on what comes out of China in terms of the order flow. You look at the luxury industry, they're pushing this. It's interesting to hear Bruno Le Maire talking about the fact that it's not protectionism, but they are clearly in the market for some sort of help for companies like Renault. Where does that leave LVMH? Where does that leave Hermes? Where do the luxury names get left in this? What about Airbus?
Yeah.
It's a zero-sum game in some ways.
And also, then what happens when you wrap in, say, solar, for example, where so many parts are still made in China, right? So there is that trade in the energy transition, the green transition, that you still need to work with China. So, I mean, you have to wonder, too, if it needs to be more manufacturing subsidies or demand. You need to de-risk the demand side in Europe. Like, is that what you need to do rather than focus on the supply? Is it de-risking the demand? Does that mean more subsidies? Is that what that is? I mean, I feel like there's just different parts to it if that's going to work.
But that then deals with the idea that maybe the Chinese are the ones that benefit from that. Maybe it's Europe needs to figure out the IRA side of things and bring manufacturing in.
Maybe. No, it's a fair point. Okay, we're going to discuss this much more in the next couple hours. But coming up, the UMich survey came out. It's moving markets. We'll get the latest. This is Bloomberg. About an hour into the U.S. trading session, here's the deal. You just kind of sell all the stuff. You're selling treasuries, you're selling a dollar, you're selling stocks. That's sort of the broad stroke for the market day. Abigail Doolittle is tracking the moves. Abby?
Yes, stocks are certainly heavy on the day, Alex. This is a 5-day chart of the S&P 500. So we do have a gain after last week's loss. Now, that said, we're well off the highs. It's triple witching day as well. So we could see anything happen. The NASDAQ 100 right now about flat on the week. So a bit of volatility and uncertainty on the part of investors. And I would say that the sector composition on the week, well, it's pretty bearish. Let's take a look at what is happening beneath the surface. Now, most sectors are higher, but the best sector is utilities. This is defense. What makes it so interesting, we also have yields higher, so it's not